So today, we're going to dig into a really fascinating story from the Indian stock market. It's all about a company called Dachepalli Publishers. Now, these guys have been around for over 100 years, but they recently decided to go public with an IPO that, well, let's just say it really did not go as planned. Okay, so let's get right into the big question, the central mystery here. How on earth does a business with this much history, this much of a legacy, get such a frosty reception from investors on its very first day? To figure that out, we've got to rewind a little bit. Right, so before we even get into the numbers, we have to understand the company's story. Because with a business like this, the story is the foundation. This isn't some hot new tech startup that popped up last year. We're talking about a real legacy here. Just take a look at this timeline. We're talking about a business that kicked off as a humble little bookstall way back in 1908. I mean, that's over a century of history. They officially became a company in 98, and then, after all that time as a private, family-run operation, they finally decided to go public in 2025. You would think a company with roots that deep would have this amazing, triumphant debut, right? But nope, they didn't, and that's the puzzle we're here to solve. All right, let's set the history aside for a second and just look at the cold, hard data. You know, numbers don't really have an opinion, so let's see exactly what went down when the company hit the market. So the company set its starting price, the issue price, at 102 rupees per share. This was the price they offered to the very first investors, kind of setting the baseline value for their big public debut. But then the market opens, and boom, the stock starts trading at just 81.60 rupees. That's a 20% drop right out of the gate. For an IPO, that is not just a bad sign, it's a full-on five-alarm fire. And things did not get better from there. The stock very quickly was trading at a discount of over 21%. This is what the financial news politely calls a subdued debut. And it immediately got people asking, wait, was this company way overvalued? Or is there something else going on here? So with a debut that disastrous, you gotta wonder, what was the company's side of the story? I mean, why were they so confident to go public in the first place? Let's take a look at the official narrative they were pitching to everyone. So this was the story they were selling to investors. They were basically saying, look, we've got the stability of a 100-year-old business, but we have the vision of a modern one. They pointed to their massive expansion across India, their huge catalog, and they said the real secret sauce wasn't just the books. It was about creating this entire educational ecosystem for schools. And this quote right here, it gets to the absolute heart of their strategy. By bundling everything together, books, digital tools, teacher training, they weren't just selling a product anymore. They were selling a long-term partnership. The idea was to make themselves totally indispensable to schools, which would create predictable, steady revenue. And you know what? On paper, that's a story that investors should absolutely love. But not everyone was buying it. One financial analyst in particular had a very different take, and he pointed to what he called major strategic blunders in how the company approached this whole IPO. His whole critique really started with this gut punch of a quote. 100 years in the business, and your company's only worth about 150 crore rupees. To this analyst, it was, in his own words, not digestible. It just didn't add up, and it made him question everything else about the IPO. So the analyst then broke down his worries into 3 key points. First off, that super low valuation. Second, he wondered if maybe this was a sign of a big cash-based business, which is pretty common in older family companies, that just wasn't showing up on the official books. And third, and this is a huge red flag for any IPO, the lead manager handling the whole thing, it was their very first time. That adds a massive layer of risk. Okay, so we've got 2 completely different stories, the company's bright vision of growth and the analyst's stark warning of strategic blunders. So after that rough first day, how did the market vote? Let's check out the stock performance. Well, the market's verdict was swift, and it was brutal. In its first week, Dachepalli's stock absolutely plunged by over 20%. You can see it right there on that first bar. And before you think, oh, maybe it was just a bad week for everyone, just look at the other 2 bars. The whole media industry was down just a tiny bit, and the wider market was down less than 3%. This wasn't a market problem. This was a Dachepalli problem. Now, let's put this company right next to an established competitor, S. Chand & Company. Wow. The difference is just staggering. Just look at that revenue line. 64 crores for Dachepalli versus over 730 crores for S. Chand. This isn't just a small difference. They're playing in a completely different league. All of a sudden, that analyst's skepticism about the company's small size starts to make a whole lot of sense. Okay, so we've looked at the history, the disastrous debut, the company's big pitch, and the analyst's takedown. So what's the verdict here? And more importantly, what does the future hold for Dachepalli Publishers? When you boil it all down, this is really a tale of two completely different ways of looking at the same company. On one side, you've got the bull case, this great story of a legacy business that's modernizing for the future. And on the other, you've got the bear case, a cautionary tale of a family business making some really big mistakes on its way to the public market. So if we put all the IPO drama aside for a second and just look at the company's fundamentals, what do we see? Well, on the one hand, there are some serious strengths. Their earnings grew by over 134%. That is incredible, and its price-to-earnings ratio is pretty low, which some investors might see as a sign that the stock is a bargain. But on the other side of the coin, you have some huge risks. Their debt isn't being covered by the cash they bring in. And here's the real bombshell. Debtor days of 354. I mean, think about what that means. It means that after they sell a book, on average, it takes them 354 days, almost a full year, to actually get paid. A business cannot survive for long if it has to wait an entire year to collect its cash. And that leaves us with this one big final question. Is Dachepalli Publishers a hidden gem, a traditional business with fantastic profit growth that the market just doesn't get yet? Or is it a textbook example of what can go wrong when a family-run company steps into the big leagues without the right strategy? The next chapter for Dachepalli is definitely going to tell us which one of those stories is the right one.